If you're a US person and you're trying to escape the US now that Trump has been elected, here's some things you must be aware of if you're gonna start living outside the US. Hi, my name's Cameron. I'm the founder of BizBud, where we help entrepreneurs, digital nomads, small business owners play the tax game and optimize their situation so that they can focus on their businesses and doing what they do best. First thing is the FEIE, or the Foreign Earned Income Exclusion. We've talked about that in other videos, so you can go watch that. This is just a brief overview of each of the ones, so we're not going to get into too much detail of each. But the FEIE says that if you live outside the US 330 days or more, you don't have to pay federal income tax. Now, that does not exclude you from self-employment tax, but it is nice because you don't pay federal income tax. The second thing is the foreign tax credit. So there's a difference between the FEIE and the foreign tax credit. The foreign tax credit is more for people who live in a certain place. So like, let's say you move to Bali, you are a tax resident there because you stayed there the whole year, you triggered domicile, and now you've been paying some tax on your income to that government. And so let's say you live in Bali, you're living, the life, and you're eating acai bowls, going surfing every day, running your business online, and you pay the 22% tax that Indonesia has for tax residents there or for their business or corporation. So you pay that tax at your business or personal level, depending on your structure there. And then you can, if you take the foreign tax credit in the US, then you can say, let's say you had $100,000 of income, you paid $22,000 to the government in Bali or in Indonesia. Then you would say, hey, US government, I've already paid $20,000. So they would say, oh, okay, you have $100,000 of tax. The tax bill you would have in this case, let's say you're at the 20% tax bracket plus your self-employment tax. So let's say you owe $35,000 to US taxes. Well, they would say you paid 22 already, so that tax credit would offset the 35. So then you would still owe only $13,000. 35 minus 22 is $13,000. And that's what you would pay to the US. So the foreign tax credit is basically like for like, so you're not getting double taxed. Now in that situation, you would probably want to take the FEIE, because one distinction is you cannot take, in most cases, you cannot take the FEIE and the foreign tax credit. You have to choose one or the other. Next one is the foreign housing credit. So the foreign housing credit basically is an exclusion of income on a credit for foreign housing. To have foreign housing credit, and sometimes this varies depending on the city, more expensive, it goes up or down, but it essentially says that you can get a credit for your housing expenses in that city, starting after a certain amount. So at the time of this video, it's $19,200. So anything you spend on housing that's above $19,200, you would get a credit for that. So for example, let's say you live in Madrid, you're working on your online business, and you spend $24,000 on rent, utilities, maybe you bought some furniture or some other things that was related to your house, and let's say the total was $30,000. So you get up to $19,200, you couldn't take a credit for that. Anything above that, up to $36,000, you would be able to take as a credit. So in this example, you had $30,000 you spent, $19,200 you wouldn't be able to get. So, but $10,800 you would be able to take as a housing credit on top of your FEIE. So let's say, for example, you're self-employed, doing your thing, and you're living in Madrid for the year, and you got a visa and everything, and you made, let's say, $140,000. Let's say you make $140,000, and the FEIE takes you up to $126,000 you can exclude, don't have to pay income tax on. But now in this example, you still have $14,000 that now you have to pay income tax on. But now you have that housing exclusion or credit, because you spent $30,000, you now have $10,800 that you add on top of that $126,000. So in total, the amount of exclusion is $136,800. So that's kind of how the housing credit could work, and it's nice. It adds on top essentially the FEIE, and it's something that you should be aware of and make sure whoever you're working with doing your taxes is aware of that, or is taking that advantage of that for you. The next thing you should know about is the report of foreign bank accounts, or FBAR. What FBAR is, it says that you have to report if you have any accounts that together total over $10,000. So for example, when I used to play professional soccer, I had an Icelandic bank account because I played in Iceland, lived in Iceland. And so when I filed my taxes in the US, I had to report because my bank account there was more than $10,000. I had to file the FBAR to report my foreign bank accounts that were over $10,000. And if you don't do this, the penalties can be steep. If you have willful failure to file, which is you basically knew, it could be up to 100 grand or more depending on the situation. But if you didn't know, they still could penalize you up to $10,000 for each form. So you want to make sure you're not messing around with this. Now people might say, how would they know? Sometimes they might not, but you don't really want to take that risk because that's not a game you want to play with, because if they ever did find out, the penalties and fines and everything would not be worth the risk of that you were trying to save at the time. Now, a lot of times now with KYC, know your customer, with all these banks, there's a lot of integrated reporting that they're all doing and talking to each other, or they're trying to make it more transparent so people are not getting around this. So the FBAR is something you should be aware of, and making sure that you are at least reporting that if you are living in other countries and opening up different bank accounts. And one last important note, it is the aggregate of all the bank accounts. So if you run a business in Spain, but you also might, you lived in, or you used to live in Bali, or you used to live in Thailand, something like that, and you open up all these bank accounts. Let's say you have $5,000 in a Thai bank account, and you've got $4,000 in a Bali bank account, and then you've got another $5,000 in a Spanish bank account. Well, each of one of those does not have over $10,000, but together, 5,000 plus 4,000 plus 5,000, that is $14,000. So it is more than the $10,000 mark. So you want to make sure that you are reporting that. The next thing you should be aware of, the fourth thing you should be aware of, is the Foreign Account Tax Compliant Act, or for more fun terms, FATCA. What FATCA is that it's all those investment accounts or property or things that you might be foreignly invested in. Basically, the US wants to know about it and you need to report it. If you live in the US, if you're single, it's $50,000. The value of your real estate, basically if you buy one real estate, unless you're buying some, shack or land in a random country, then okay, maybe it's under $50,000. But $50,000 or more, if you're single, then you have to report FATCA. You have to report these financial investments. If your value of your investments go above $75,000 single at any point of the year, then you have to report it. If you're married, it's $100,000. If your value of your investments go above $150,000 at any point of the year, you have to report it. So that's something to be aware of. Now, if you're living outside the US, it goes up a little bit. Your threshold goes up. You can have higher investments and not have to report them, but it's not that much more. So if you're single outside the US, you're a citizen living outside the US, then it is $200,000. If your value of your investments go up to, let's say, 230 or 250, but then at the end, right before the new year, maybe the stocks go down or something, and now it's back to 190. Okay, you don't have FATCA if you're single. $300,000 at any point in the year, you have to report it. So let's say you have, right at the start of the year, you had 190,000. Let's say you bought, I don't know, you invested in some Polish company or something, and it really did well, and the valuation, it's doubling, tripling, whatever. And now its value is no longer 190, it's actually 500. And so 500 grand, as soon as it's crossed that $300K value point at any point in the year, then you have to report it on FATCA. If you're married, living outside the US, then it's 300K at the end of the year or 600K at any point during the year. So in that example, let's say you're married and you got $250,000 invested in this Polish farming fund or whatever, and it is at 250, below the 300 mark, but people are hungry and it starts to get a lot of business, and so now it goes up and now it's above 500, or now it's above $700,000. It's crossed the $600,000 threshold, so now you've got FATCA requirements you have to do. And you want to make sure that you do this and you're not trying to be around the bush. Penalties for not filing it, they're not fun. If you're living outside the US, all these things that the US, the penalties are not fun. They're never fun even if you're in the US, but they seem to just elevate when you're outside the US. So it's $10,000 failure to file form. If they send you a notice and you still don't file the FATCA form, the 8938, well then it's $50,000 after they sent the notice, and they can continue to rack up penalties and fines. So it's not something you want to mess around with. And yes, again, everyone always asks, how would they know? Well, they might not know, but when they do know, that's when you have problems. And that's not something we'll take the risk with our clients. We always do everything by the book, and we make sure you're maximizing anything. But they do need to know that you have these investments, so they're aware. Last but not least, we have the CFC, or the Controlled Foreign Corporations. So basically, if you own more than 10% of a corporation, you have to report this information on Form 5471, it's called. And basically, obviously the penalties here for not doing this are high, around $10,000, and go up from there. Basically what the CFC says is basically wants to know all the ownership you have in foreign corporations. It's 10% or more as a US person. There can be more details and nuance into each of that, but basically you want to make sure that you're reporting this. If you do, if you move to Dubai or somewhere or something, you're like, oh, you meet some friends, they're like, oh, we want to start, a cafe or a yacht rental business or something, and you're like, yeah, okay, I'll be 50% owner. Okay, as soon as you've done that, you put in money, now you've got CFC reporting requirements that you need to do back to the US. Because as a US citizen, as a US taxpayer, we get a lot of benefits, but we also have the unfortunate that the US government taxes on our worldwide income, and we cannot get around that. So there are some things you can do to make sure you're minimizing your tax, but again, you also want to make sure you're not getting penalized unintentionally from things you're trying to do that are good and genuine while you're trying to help your foreign friends, and maybe you're investing and you're doing all these things to help out and obviously hopefully make a profit. And then you're also triggering all these reporting requirements that you have no idea about, and the penalties are big. And yeah, you want to make sure you're not doing all this alone. Let us know in the videos, in the comments, if you knew about all of these or what your thoughts are on all of these, and we'll answer all your questions in the comments. And if you want more info about your situation, then please message us, email us, or contact us, and we're happy to help.